All right, so you clicked for the video presentation, my crash course. That's awesome. Let's get right to it because it's obvious you want information and you want to discover what it is I can do for you. Okay, so I believe the IRS tries really hard to take the fun out of being successful, and they do this by creating obstacles to get in our way. Because of these obstacles, I believe successful people like yourself deserve the opportunity to learn how the tax code allows you to get your assets positioned in such a way that when it's time to finally use those assets, you are completely exempt from both federal and state income taxes, regardless of the income level and regardless of the state you reside in, but also regardless of the age that you use them. That's the big one. Now, how I do this is by demonstrating the tax code that allows it to happen. What I do is make it possible for you. So let me go to the whiteboard real quick because I want to see if we can uncover what it is you want. So I want to draw a circle, and this circle represents a pie, and it's your pie. It's everything you have financially, both currently and going forward in the future. I'm then going to take a knife, and I'm going to cut the first slice in your pie and then hand you the knife, and you get to decide where the second slice goes, and it will determine how much of your overall wealth you want to share with the IRS. Now, how big would you make that slice? Again, if it was your choice, if you controlled it, what would you do? I'm sure you said something like everybody else does to have this with, like they either say, Kelly, I'd put the knife down, I wouldn't cut another one, or maybe I just put it in the same spot. And what's interesting to me is that you just admitted you want control of the knife. Well, what I do is make that possible for people as close as we can get. How I do it's by demonstrating the tax code and the laws that allow you to do this. And why I do it is because I believe you deserve an opportunity to get what it is you want. Now look, over the years, I've come up with an analogy that I believe fits everybody's financial life perfectly. It's climbing a mountain. You see, there are three phases to climbing a mountain. You have the ascent, you have the summit where you stake your flag up top, and then you have the descent, coming back down. Now, financially, when we are accumulating money, that is our ascent phase. We are accumulating. And accumulation can be defined as this. It's when you have income and you set money aside into some assets to invest and grow in order to create income for you later. And you see, that's when we officially stake the flag, or stake the R in our flag. That's retirement. We're officially at the top of the mountain. And now we begin the descent, which is distribution. And see, the retirement time frame, what that involves is the distribution of our assets. Now, financial planning, current financial planning, both starts and stops at accumulation. Do you remember that ad that was a few years ago where people were running around with their big green number that they were holding? They're saying, you know, what's your number? What's your number? It might have been Fidelity. I don't remember who it was. And they showed someone with like 2 million and someone with 4 million. The problem with that is it's 100% focused on the accumulation side only. But the person with the 2 million very well might have had more income for distribution over a longer period of time than that one with the 4 million. You see, we want to get away from only focusing on what's our number. The problem with distribution is there are all kinds of complexities. And you might not believe me in this, but in 15 years of doing this specifically, I have yet to come across somebody who has a distribution plan, an exit strategy when they finally make it up to the top. Now, there's a couple things that are important to understand, and let's look at rate of return. There's a rate of return on both sides of this mountain. And the easiest way to remember it on the accumulation side is it's a rate of return on your money. So if you had $100,000 and you got a 5% rate of return, then that next year you start with $105,000. So you're growing. You have a rate of return on your money. The easiest way to remember it on the distribution side is it's a return of your money. And it's called often a safe withdrawal rate. And a lot of the traditional shops will use what's called a Monte Carlo calculation. And all it is it's a percentage, and it calculates a risk. So how much do you have? What's your number? And then what's the safe percentage that you can withdraw of that number and get all the way down to life expectancy? You see, retirement is not just, let's just say, age 65. You have every single year along the way that you have to make it down to ensure you don't rely on somebody else. When only 2% of retirees are actually financially independent, there's a major problem. And I believe it's the focus of only accumulating. When it comes time to distribution, we have a whole bunch of issues that we need to make sure we have plans for. The biggest is taxes. We then have Social Security. We've got legacy. What is it we want to leave, if we want to leave anything to our family or charities? Inflation. Our withdrawal rate, so we're not outliving our money. There's all kinds of concerns on this side, and this is why I believe there's only 2% of people that are actually independent financially. Now let's get back real quick to our circle. Within our circle, there are actually 3 types of money. You have lifestyle money. This is money that you are using and spending in order to fund your lifestyle. I am not a lifestyle coach. I could really care less what you do with your lifestyle. That's up to you. You then have your accumulation money. And this is money, of course, that you're setting aside, that you're working to climb up the mountain. The end game goal is, of course, to have the accumulated money be big enough to fund the lifestyle. I have yet to meet a retiree who wants to drastically decrease their lifestyle in order to make sure they live long enough. If you've been making 100 grand, 200 grand a year, and then you retire, to end up in the lowest tax bracket, what do you need? The lowest income. I've yet to find somebody, yes, their house is paid off and all that, but now they're golfing all the time, they're traveling. So those expenses still exist. But nobody wants to come drastically, at least I have yet to see them, drastically lower their lifestyle. If anything, you've retired and now you get to maintain your lifestyle. That's the goal. Now this third type of money is where I focus virtually all of my attention, and I call it transferred money. And it's defined as money you're losing unknowingly and unnecessarily. Now you might say, well, Kelly, I've got a really tight handle on my money. I'm not losing anything unknowingly and unnecessarily. Well, let's look at a couple examples. First, taxes. Now, look, you mentioned just before that you would want to control the knife if you could. Well, what if you could, and you were not in that position, and the IRS got a bigger chunk of your pie than had to have occurred? What if that was the case? You see, that would be a transfer of your wealth. It was an unnecessary transfer. The next is Social Security. That's a big one. This one really bugs me, and I want to get into some details on this, and here's why. We all fund this with our after-tax money. We're promised it. So here's a very important question. I'm going to come back to this a little bit later too, is who do you believe gets their Social Security? Typically those people who are poor or who have no income, right? So those who really quote-unquote need it are the ones who get it. Those who show income do not. And that's a problem. So what if, regardless of your income, I said that earlier, regardless of your income, you could be in a position to get 100% of your Social Security, would you take it? It's a question only you can answer. If you could have $500,000 of spendable income and get 100% of your Social Security, would you take it? I would, if I'm paying into it. Okay, so let's look at a third big transfer, and it's debt. Now, debt can often be considered a 4-letter word, but there's a lot of good debt, but I want to talk about bad debt. And let me give you an example to demonstrate this. Let's pretend for a minute that you come to me because you are in desperate need of $50,000, and you've gone to everybody. The banks have declined you, family, friends tell you to go hit the curb. You need it. And I know who you are, but I stay there nice and quiet, and I write you a check, and then I write in big letters, loan, in the little memo line, and I slide the check over to you. What are the 2 things you're going to want to know about that loan? I think it's pretty easy to figure this out. You're going to want to know, well, Kelly, what are the terms with this loan of yours? And what is the rate? Now, let's pretend I said this. I said, look, I know you're hurting right now, man. I know everybody's declined you, and I don't want to burden you with the payment. So let's say there are no terms for now. Just use the money for what you need. We'll figure out the terms later. You might agree to that. But here's what I say about the rate. Here's how the rate's going to work. There is no rate right now, but at some point in time in the future, when I determine what my needs are then, I will decide the rate and make it retroactive to today. How would you feel about that loan? Hopefully, you agreed that's the worst debt imaginable. Debt with unknown terms, not controlled by you at all, and unknown rates. There's no way you would take that loan. Now, what I just described perfectly, to a T, is the #1 retirement vehicle used by the majority of Americans. Any guesses? Some people say a house. No, it's not a house. Let's take a look at this. What I just described to a T is a 401k and an IRA. Now, how is that? Well, if you were to bring a statement to me and your 401k, let's just pretend that's what this is, your 401k shows $1 million in it. I have one question for you. How much of this $1 million is yours? Now, you see, most people, and I get a lot, they think it's a trick question. And I have had a lot of people go, the million. Like, no. Actually, what is the only answer you can give me to address that question? The only answer is I don't know. You see, you have no idea. The reason is because you've had a partner in this all along. And that partner is the IRS. And how much are they going to take of it? We don't know. So look at the problem this creates as we are trying to come down the mountain over a long period of time, all the way out to life expectancy. You see, if we staked your flag, if you did, and you're just, again, for examples, you're 65 years old up here, and it's time to use this asset for income, we only know what the tax rates are today. You only know that percentage. If you were to say, well, Kelly, should I take out a little bit less because tax rates are going to be lower next year, or vice versa? Should I take out more because they're going to be higher? What's the only answer I now can give you as a planner? Same one you had. I don't know. You see, we have no idea what the tax rates are going to be. We don't know what they're going to be next year. We certainly don't know what they're going to be every single year of you coming down the mountain, hopefully for the entire, 30 to 40 years. We have no idea. It poses a major, major problem because you have zero control over the terms. The terms can change. They have what's called required minimum distribution. So at age 70 and a half, you're required to take it out. Well, what if that negatively impacts your overall income that you had planned and that puts you in a bigger tax bracket unnecessarily? That's a bummer. But what if they decide to change the RMDs to 68? Can they do that? They can do whatever they want. They own the terms and they own the rate. Now, if you truly believe you're going to be in a lower tax bracket in the future, then you and I probably aren't a fit. Because you trust that the government is going to make sure they don't collect your taxes today while you're accumulating, and that they promise you they're going to let you pay less on them in the future. But while you're accumulating, if you access that money, they're going to charge you a 10% penalty just to make sure they get more. You see, the idea you're going to be in a lower bracket is completely bogus when all of your money is sitting in this thing. It's kind of like sitting on a teeter-totter. Right? If you are the only person sitting on a teeter-totter, the game really sucks. It's super boring. All you do, you just want someone to come over and apply a little pressure. Well, see, if all of your assets are sitting over here in the fully taxable position, then your distribution of coming down the mountain is completely susceptible to the pendulum swings of our politics. That's not very fun. So this actually has happened, People realize this, they get to the top of the mountain and they realize this is crap. It's kind of like climbing the mountain and only then discovering what you need to get back down. That would be a major problem. So here's what some people have done. They have said to their planners, and they've said, well, I don't want to ride this roller coaster all the way down. What if I just take all the money right now and just deplete the thing? And I actually had someone comment on me years ago to where they said, how ridiculous, this old YouTube video, no one's going to do that, that's so stupid, that tax rate. Well, when 73% of retirees do it, 73, because once they get to the top, they discover this unknown terms, unknown rate for the rest of their life, and it poses a big problem. So like, you know what, I want to yank out of it. But here's the problem this creates. As you know, we have a stair step on the way income is taxed. So let's just say the lowest income is 10%, the second is 15%. These are not totally accurate, that's irrelevant. Let's say 30 and 35. So we have a progressive income tax. If you pull money out of this, it's 100% ordinary income tax. So if you deplete the whole thing, if you depleted this $1 million, well, you're going to blow up this level at the 10. You're going to blow up this one and this one and this one. And virtually all of this $1 million is going to be taxed at the highest ordinary income tax rate that exists. So was that the smart decision? What's my answer? I don't know. So the majority of Americans, that teeter-totter example, climbing a mountain and being on a teeter-totter, are my two favorite illustrations because they fit so well. Everybody, the majority of Americans, have their money sitting over here to where they don't control the terms and they don't control the rates. And it poses a huge problem. And what we need to do is try to get some pressure on this side in order to offset. So let's look at 3 things that we can do. We have 3 options. Number 1, and this is, again, these are your choices. This is what you have the choice to do. I call this the ever-increasing tax plan. This plan is to where individuals like yourself can continue to shove their money into those types of accounts. Just keep pumping in money into your tax sheltering 401k and IRAs. Now, a little side note. What's the purpose of a bomb shelter? What's the purpose of a tornado shelter? A bomb shelter protects you from bombs, right? A tornado, when the tornadoes mow through Oklahoma and the Tornado Alley, people run to their tornado shelter so that they can open up the hatch and walk out and be alive, to protect them from tornadoes. I believe it should be completely against all financial compliance standards to call 401ks and IRAs tax shelters, because the very last thing it protects you from, literally, is taxes. If anything, it's a tax harvest. It's not a shelter. So your 3 options are: you can continue in the ever-increasing tax plan and make that side of your teeter-totter even heavier, or you can flatten the tax curve, and this is done with what's called a 72T. Now, this is in the tax code, and what it allows you to do is it allows you to systematically withdraw money prior to age 59 and a half so that you avoid the 10% penalty. And there's a lot of strategy to this. It's very rare that we do this one. As you can imagine, the government has all kinds of rules. I mean, a 401k is just tax code, right? Section 401 Part K. A 72T is just tax code. So as you can imagine, there's a lot of implications and rules that have to be followed. But it does create an opportunity to flatten the tax and get out of the ever-increasing tax. And then, of course, we just have the decreasing. We have, and I refer to this as the get out. This is, we get out, and we get out as quick as we can. We may have to wait till we're 59 and a half, but we have to have a systematic plan in place to help offset and create some pressure over here. Now, think about this from a balanced teeter-totter standpoint. If we've effectively done this, and again, it's really difficult to do it after you've staked your flag, you've got to take the tools with you to have them at the top of the mountain. But imagine you're in this position, and you have controlled on this side. You don't have control on this side of the terms and the rates. But imagine rates are very, very favorable. Well, what you could do is leave this side cooking, and you could distribute more money from this. But what if the opposite is true? What if rates are not favorable? Well, you could drastically minimize what you pull out of this one and pull out of this. So you're always able, none of us know what's going to happen, but we're always able to have a plan as we come down the mountain year by year, political pendulum swing by pendulum swing, right? Okay, so now let's get into somebody who, let's just say, again, I know everybody's opinion of retirement can be different, but let's just pretend that this person's 65 and they want to be done. They have 4 types of taxes that they can and potentially will experience. There's only 4 in retirement. This very first one is ordinary income. I call these buckets. This is bucket number 1. It is our ordinary income bucket. And the different accounts that fit this is obviously your 401ks, your IRAs, any business income, any real estate income, etc. So whatever we're using for income then is this would fall under the ordinary income bucket. Now let's pretend this individual decides to take $80,000 in distribution for their retirement income. Now, you've got to remember, in the ordinary income bucket, you have to pay two entities. You have to pay the federal government and you have to pay the state. The state of California right now, I think it's what, 13.3%, and it keeps going up because they just can't seem to get it right. 13% on top of the federal. So the most the IRS could tax you today would be $35,000 of this money, leaving you $45,000 of spendable income. Oops, wrong color. $45,000 of spendable income. That's it. Now, what's really fascinating to me and what really boils my blood is that if you have $80,000 of taxable money, the IRS, our government, is going to tax 85% of your Social Security. You see, they literally believe you have more money than you need, which drives me nuts. So think about this. If you show 80 grand of an income distribution that would be in an ordinary income bucket, then 85% of your Social Security gets added back on top of the 80 and taxed again at the highest tax rates that exist. Now, you funded this with after-tax dollars, and it's going to be re-taxed. It's amazing how many people don't know this. They've calculated, they've done the calculations of how much Social Security I'm going to get, and then they think that's going to be part of their income, when in fact 85% of it is taxed again. It's horrible, at only roughly 80 grand. Now, bucket number 2 is our capital gains bucket. And of course, this is, any growth on, if there's a growth in investments, this is a sale of a business, sale of real estate, right? Anything that has a capital gains tax to it. And let's take our 80 grand from this. So if in bucket number 2 in retirement, this 65-year-old distributed $80,000, then this is how the capital gains works. You see, what the government, what your accountants, your CPA, the government's going to want to know is how much of this overall asset here was growth and how much was your contributions. So let's just pretend this was an investment account. It was an after-tax investment account. And over the years, you had put $500,000 in contributions, but it had grown, it had accumulated to $1 million. So what this means is half of this account is your contributions and half is the growth. So when it comes time to distribute money, they're going to take the full distribution, and then half of that distribution, in this particular example, would be considered your cost basis. And this actually goes back on your Schedule D. It doesn't hit your 1040. So they will take then $40,000, the remaining, and that's what is considered taxable. Now, capital gains tax is often referred to as the most advantageous tax in all the tax code. I disagree. I think no tax is most advantageous. Most financial practitioners use a 20% capital gains tax. So if we have $40,000 of cap gains taxable money, and if we're taxed at 20%, then we would owe $8,000, leaving us $32,000 after we pay the tax, plus our $40,000 of cost basis, which means we would have $72,000 of spendable income. Now here's what's interesting. We have the same outflow, the same distribution, but we've got far more spendable income than over here out of the ordinary income bucket. But something else that really frustrates me is if you show $40,000 of taxable money, the IRS is so nice that they are going to tax 50% of your Social Security. They don't believe you're wealthy beyond your wildest dreams anymore over here, but they do take 50% of your benefit and re-tax it for a second time. Boils my blood. I hate it. Now let's look at the third bucket, which is our tax-free bucket. And what fits into here is muni bonds. Now some people say, well, Kelly, Roths are tax-free. No, they're not. They're over here. So if we were to take a $80,000 distribution from our muni bonds, then the best part here is we don't pay any tax. They are truly tax-free, and you get a spendable income of 80 grand. Again, look at this. We keep moving away from the component that they really control all the terms. We get the same distribution, more spendable income. But here is the kicker. And this one, again, drives me crazy. Because you show 80 grand of tax-free money out of a muni bond, they believe, again, you don't deserve all of your Social Security, and they tax 85% of it. Again, isn't that so great? They're just so nice. So now let's keep moving over to the right. We have the tax exempt bucket, is what is bucket number 4. And first, let me define what I mean by tax exempt. The definition of this, if you take $80,000 from this account, it is treated just like your tax-free, meaning you have total 100% of spendable income from that. So the 80 grand has no tax, you have 80,000 of spendable income. But here's the difference, and it has to do with Social Security. 0% of your Social Security is taxed, meaning you get 100% of it. You get 100% of your Social Security. You see a distribution from a tax-exempt account, none of it goes on your 1040, therefore there's no means testing. And that's great. Now here's the beautiful part. It doesn't matter how big that distribution is. If it's 80 grand, if it's 20 grand, if it's $420,000, if it's $1 million, it doesn't matter. I actually have a client, I'm going to dig into that here in a moment, who from his tax-exempt bucket has a $420,000 distribution. He gets 0 taxed on his Social Security, so he gets 100% of his Social Security benefit. He even qualifies for the state of California's EBT food stamp card because nothing hits his 1040. He doesn't take that. He believes that's abuse, but he could get it if he wanted it because he shows that he's poor. Do you remember back at the beginning when I asked you about who gets their Social Security benefit? And I'm sure you agreed that it's those who have very little money, those who are poor. Well, if you show nothing on your 1040, what does that make you? It makes you fit into one of those categories according to your tax return. It's a wonderful strategy. Now, there are only 2 products in all of tax code, the 46,000 some odd pages, 26 feet of bookshelf space. There are only 2 products that fit this. One is a Roth. Now, the way a Roth works, you do have a tax-free distribution. However, there's 3 negatives to a Roth, and here's the first one. You get a 1099-R when you distribute money from it. So it is tax-free, it is not means tested, doesn't hit your 1040, therefore you get 100% of your Social Security, but they issue a 1099-R. There is a communication with the government. I've asked CPAs, why is that? They don't know. It's not that it's not that they don't know their stuff, it's that there really isn't an answer other than this. The government is earmarking it so they can put Roths over here, and it'd be real easy to do because everybody knows it's a tax-free distribution, but not everybody knows it's a means test or not. I fully believe that Roth IRAs will fall under this bucket number 3 and then will trigger a means test on your Social Security because of the 1099-R that's generated. The second issue with Roths is there are income limitations. So if you make about 120 grand or more, you begin to get phased out of even being able to do this, which is ridiculous to me. They will tell me that I can do $50,000+ into a SEP IRA, but because I make too much money, they do not permit me to do this tax-exempt bucket number 4. Why? That's really fascinating to me. I mean, if they're going to allow me to be in a lower bracket and make sure that they take less, then, I mean, seriously? That's a complete joke. Now, so there's income limitations, and most of my clients don't qualify for the Roth. And number 3, even if you do qualify, there are contribution limits. If you qualify, they only allow you to do what, like $5,500? So now imagine that. If you have the ability to put money into these, you never can get it big enough to where it's going to last you very long coming down the mountain. It's certainly not going to satisfy that whole teeter-totter thing, right? When you look at most people are sitting like this on the teeter-totter. Being by yourself on a teeter-totter is a pain in the butt. It sucks. You just want someone to apply pressure. Well, most people are sitting over here with all their assets on this taxable side like this. And they're means testing to where the terms and the rates are not controlled by them. And we need to apply a little bit of pressure. So if the Roth fits over here, you can't get very much money to help balance this out. It poses a problem. So the only other product in all of tax code is overfunded life insurance. Have you ever heard of it? If you haven't, it wouldn't surprise me because only 4% of all policies are actually overfunded. And what's very intriguing to me is who makes up this 4%. Number one, banks. Banks have more of this than any entity on the planet. Bank of America has roughly $30 billion. Are you kidding? If you look at the top 5, you can go to FDIC.gov, you can look at line 41 of their assets and liabilities. They all have $25 billion plus in their insurance holdings. It's crazy. It's referred to as their tier 1 capital. Number 2, our politicians. Now, the very fact that our own politicians, who by the way exempt themselves from like 401ks and all that, they still have your traditional kind of pension plan, insurance type of structure. The very fact that they do this, I've got a colleague who has a current client, he's a current sitting senator, who does over $500,000 a year into his insurance bucket. He's not going to vote himself out of the benefits of that. So politicians have hundreds and hundreds of thousands of dollars in this tool. They make up certainly one of the largest portions of the 4%. And number 3, the wealthiest Americans. Now you may have heard insurance as the super Roth for the wealthy. It has nothing to do with the wealthy. It is a super Roth, but it has nothing to do. There is nothing in the tax code that stipulates a wealth component to the insurance. You just have to be able to get it. That's all. So what are the banks, the politicians, and the wealthiest Americans? What do they know how to do very well? They know how to control the knife. They know how to limit and not be tax hardened, limit what transfers unnecessarily to taxes. But the biggest is the control. They know how to control and maintain control of their capital. All right, so let's do a quick, what I call a 10-minute lesson on life insurance. So let's look at this. Let me just draw this big rectangle. This is an insurance policy. And let's pretend for a moment that you go out and you're shopping for an insurance policy. There's a minimum that you could pay for this insurance, and there's a maximum that you could pay. Who determines the minimum? Is it you? It's not. Because if you determine the minimum, you'd say, hey, give it to me for free, right? Is it, who else would it be? It actually, and you might have guessed it, it's the insurance company. The insurance company underwrites you based upon your sex, your habits, your blood, whatever, all your health history. And they will say, hey, based upon your health, we're going to give this to you for X at the smallest amount, right? This is term insurance. So they're willing to take a chance that you don't die. If you do, then they lost the bet, right? Less than 2% of all term insurance actually pays out a death benefit, meaning the person actually died during the term. So they're cash cows for insurance companies. So we have a minimum for that life insurance policy. But who determines the maximum? Who determines the maximum of your cash you could pay for a life insurance policy? And that's a bit of a paradigm shift. There is a maximum. Did you know that? It's not you. It's not the insurance company. It's our government. And the very fact that the government got involved and put a maximum of what you could do with your capital, what does that tell you about this? Remember those terms that they like to control? It tells you it's really good in regards to your control and accessibility to capital, and it's really good in regards to taxation. Otherwise, they wouldn't put a limit on it. Now, I've got a guy, I worked with him earlier this year, and he wanted to do $120,000 into his insurance policy. I'm going to put it out here. He wanted to direct $120,000 per year into his insurance. Now let me ask you this. If you knew this guy, if he was a buddy of yours and you went out for a little happy hour and you knew he was successful, but you never really talked about it, but you end up digging in and you ask him and he ends up telling you that he puts and spends $120,000 a year in life insurance premiums, what would you think about his life insurance? I guarantee you would think he has an enormous amount of life insurance. Well, I've got this guy. I worked with him earlier this year, and let me show you. So what we did was we asked the insurance company, what's the smallest life insurance you will give us? I'm going to do this in blue. What's the smallest life insurance policy you'll give us in order to make it about the cash and not about the insurance? And here's what they said. They underwrote him, and that number came out to be $2,800,836. Now, we could have got this in a term policy from him, or for him, from the insurance company for roughly $2,900 a year. So the way he was underwritten, if he wanted $2.8 million with them, it would have cost him $2,900 per year. That's the minimum. So why in the world would he be willing to put $120,000 into this insurance policy? Well, first of all, look at this number. It's only buying $2.8 million. I guarantee you, if your friend came to you and said, "Hey man, I spent 120 grand," you would, within your mind, you'd be thinking he's got at least, what, $15 million? Only 2.8. You see, we want to squeeze this corridor that the government sets in order to minimize the insurance and maximize the cash. We want to overfund it. Now, I'm the stupidest insurance guy on the planet, because guess what we get paid on? We get paid on what goes to insurance. We don't get paid on what goes to cash. So if I'm using a guy like this to get the smallest life insurance policy, then I'm doing the right thing by him. That is for sure. Now, why would he do this? Why would he be willing to put $120,000 into a life insurance policy that only has $2.8 million of life insurance? Well, it's because of the benefits. So let's take a look at those. There's 19 of them. Number one, you get a tax-free accumulation. As this grows, you're not taxed on it. Number two, you can distribute it tax-free. Number three, you can pass it on tax-free. Number four, you have no penalty to access the money prior to 59 and a half. That one's a huge one. Number five, you have no penalty to access your gains. That one's fabulous. You actually get access to gains without any penalty. Number six, you have a tax-free death benefit that always exceeds the amount you have in there, meaning if you happen to pass away, your family or whoever you want to pass the money on to, charity, whatever, gets more than what you had in there tax-free. It's beautiful. 7, there is no 1099. There's zero communication. A distribution from this absolutely does not hit your tax return. That's how it's tax exempt. No 1099 means no means testing. Money in here is not subject to creditors. You think that's appealing to wealthy people? You bet it is. You think it was to O.J. Simpson? That's where his money was. He was found liable to the Nicole Brown family. He didn't pay a dime. Number 10, money inside of these is not subject to the alternative minimum tax. Hate that tax. Number 11, has a very competitive rate of return. You've probably heard that these things have a horrible rate of return, but it's just false when you consider all the other math and the complexities going into distribution. Typically, to compete against this type of policy, people have to get anywhere from 9.5% to about a 12% rate of return every year without ever incurring a loss after fees just to compete against it in distribution. Number 12, policy has guarantees. You cannot lose money, ever. Number 13, you also have a provision called a waiver of premium. This one is huge. If you were to become disabled, the insurance company continues to pay your premium. Now think about it from this guy who had 120 grand that he was shoving into it. If he became disabled, they will continue to pay his premium, which means it will continue to accumulate in a cash-heavy standpoint. He has a self-fulfilling accumulation strategy. He doesn't just have a disability insurance policy that pays him a little bit of percentage of his income. He's still accumulating as if he was still working the same. Very, very important. Can you imagine if an IRA or if an investment house offered that if you're contributing 50 grand to your IRA and you become disabled, we'll continue to do it for you? I mean, that would get all kinds of press, but this happens every day with these kinds of policies. Number 14, you have a chronic and terminal illness rider. So if it's proven that you're not going to make it, you can actually use a large portion of your policy to either get the surgery or to just splurge with your family and live, right? That's key. Number 15, there is no market risk. Now, I'm recording this during COVID. I've yet to get one call from a client because they're concerned about their money. The only calls that I get are because they see an opportunity in times of crisis, and there's plenty, and they want to leverage and use their money to take advantage of it to accumulate even more. I don't ever get any calls because none of them ever lose any money. It's key. Now let's erase this. Oh no, yeah, I'm running out of space. So what am I on, 16? All right, 16. You have guaranteed loan provisions. That's huge. No matter what, you have the opportunity to leverage your money. No matter what, you can always get a loan against it. I don't want to get into why we would do a loan. Number 17, you have unlimited contributions. How great is that? The biggest client that I have, I worked on this case a few years ago. He does over $2 million a year into his policy. Could he do that in a Roth? No, he couldn't. You could have policies on other people. You can have them on business owners to store cash. You can have it on your spouse and your kids. You have unlimited opportunities. You just have to be able to qualify for the insurance. Number 18, these policies fall under contract law versus tax law, and that's huge. I have a whole video you're going to see on this. I only work with mutual insurance companies because a policy with a mutual insurance company is a unilateral contract of ownership. So the policy falls under contract law. You can't change contract law. You can only change new contracts going forward. But tax law, again, as long as the tax law changes, so does everything within the policy. So these kinds of policies have contract law provisions, not just tax law. And 19, you have collateral capability, what I call collateral capacity. This is the ability to leverage the money without losing the opportunity to earn on it. And now let's look at how that works once you finally climb the mountain. Okay, so here's how we leverage this. So we've built this bucket. We built it in a very efficient manner. We've shoved capital in it, dancing right below the line that the IRS permits. And now we've decided to use it. Now I'm going to use the example of in retirement when we are distributing money from this. I've got some videos on how we can leverage these accounts throughout any part of our life. We can, the way that my business partner and I did it to leverage a lease in order to get an 11% return. So it's, you own the terms. If you recall, you own the terms on this. So while you're accumulating, you can use it. But in this example, how do we leverage this once it comes time for distribution? So we've got our money in this thing, and now it's time to use it. What do? We take a policy loan against it. Now the important piece to this is the insurance company issues this loan. This isn't a depleting strategy like an investment account. They put a lien against your policy. Now you don't have to pay this back because this is collateralized, but they do charge a little bit of interest. So you have a loan against it. Now loans are not a taxable event. So look at this. We have a little policy loan against it. This doesn't matter. If this is $10 million and you're pulling out 600,000, this does not go on your 1040, and therefore it is completely tax-free and therefore tax exempt. Doesn't matter how big it is. It's irrelevant. Just the only thing that determines it is how much you put in, period. But this is a very key component. And I have this video I've referenced about, I have a video that you're going to see on the types of insurance companies I work with. They must be mutual, and they must do what's called non-direct recognition. And what this means is that they will credit you the full dividend based upon your entire value, regardless of any loans that you have against your policy. So look at this as an arbitrage play, as collateral. We have a lien against it that we use for our spendable income. Doesn't go on our 1040. We qualify for everything that the government will give us. And our entire bucket is still earning. So for this to keep going, for this loan to catch up, it never would. I mean, it's not going to happen throughout your entire life expectancy. So at year 2, we do the same. At year 3, at year 4, at year 5, at year 6, and yes, there's an interest expense, but because of this structure, our entire balance is still earning the full dividend. This gives us a lot longer of a time frame of leverage in order to create our spendable income. Now, if this was just an investment account, then when you take your first year, it starts at the top, and now you deplete it. So now your account, only this is growing. Not a big difference between the two, year 1, year 2, same thing. Year 3, same thing. You're in a depleting strategy. Your account's getting smaller. So this is why they calculate the safe withdrawal rate and why it's normally 3% of the asset value. Because there's a few things going on there. Not only is it a depleting strategy, but this account still has some risk. And if it happens to go down, you look what happened in March here of 2020. If these accounts go down, that affects your withdrawal rate. It affects you can't safely withdraw that same amount anymore. It's too aggressive. So there's a lot of implications. So this is why they typically say 3% will get you all the way down the mountain and ensure you don't run out of money. But there's something else that's very important, is this type of structure must last for, actually I want to spell that out, must last for 2 lives. You see, if you die and you're depleting an investment in this way, that money has to, if you die right here, well, the rest of this balance has to continue on providing income for your spouse or loved ones. Now, if we look at the insurance, if you were to die right here and you have a loan against this, you still have a tax-free death benefit that exceeds this. The death benefit pays off the loan, and now your family gets the benefit. And what this means is your distribution strategy out of your insurance has to only last for 1 life because of the insurance. And that makes a huge difference, because if you pass away here, there's a huge influx of capital for any beneficiary in order to make sure that we can get them down the mountain to life expectancy with no problem. So here's what we look to do. Something to remember is this is an insurance policy. You can't get it if you need it. You can only get it if you want it, right? If you're in need of it, they're going to decline you. So what we look to do is take an application, get a nurse to come out to you. They draw a little blood, take a little urine, and while it's being underwritten, I want to do this. I want to look at what I call old money and new money. Now, old money is money you already have sitting in your different buckets: the ordinary income, the capital gains, the tax-free, and if you happen to have any, in the tax-exempt. Your new money is money that you are contributing to these on a regular basis. And here's what, while you're in underwriting, what we'll look at. We very well may take some of this and direct it over into this pile. Now, it's rare, it's really rare, as you can imagine, because of the terms are completely controlled by the government, but we may take and have an opportunity to get some money out of the ordinary income bucket to transfer over here, but it's not that common. But we will definitely look at your new money. Are you funding the ever-increasing tax plan, and do you want to stop? Again, if we look at this as the teeter-totter, are you really heavy over here? And are you continuing to funnel money there? So we may very well just begin to redirect some of that into this in order to apply pressure. Now again, why do we want to do that? Because of this. We want to be structured like this. Because what if tax rates are really low? Well, you could be distributing from this thing and enjoy that, and maybe very little, if not, you might not even touch this side. But what if the opposite is true? What if a pendulum swing happens politically and tax rates are high? Well, we could touch very little over here to make sure you in fact are in the lowest tax bracket and distribute more from this. You see, what this allows us to do as we're coming down the mountain is it allows us every single year to be strategic. You can only do this when you're balanced. You cannot do it when you're heavy on this side over here, because they own the terms and they own the rates. So what this comes down to is this type of strategy has nothing to do with the product. It has everything to do with the tax code. And if you're more concerned about the name of the product, then we will not be a fit. Right? There's a lot of people who just hear insurance and they automatically turn off. They're unwilling to even look at what it can do and why the wealthy use it and why the banks use it and why the politicians use it, because they just don't like the name. So it has nothing to do with the name and the product. That's everything to do with what it can do for you. And if you said earlier that you want control of the knife, and if you're one of those that's phased out of the other options, this is the only way you can do it in tax code. So this is what I would look to uncover with you. We run that parallel track. While you're getting underwritten, we want to I'll look at the new money, the old money, what you're wanting to do, what kind of distribution you're thinking. Do you have any future there's a great video on how we can design these policies to have a void so that future assets can dump into them, like the sale of a business, the sale of real estate. We want to have be as prepared as we can be during the underwriting process so that once if you do get approved, then we're ready to go and we can begin to implement this plan. Now look, I've already mentioned before, I have a special code. I want to put the word right here, it's insider. Make sure to use that code if you go to get on my calendar. It'll save you $500. I waive that fee completely because we've already had this conversation. You see, I find a lot of people find me and they just want to get on my calendar, but I have to go through all of this stuff with them. So because you've bought the audiobook, because you've watched this, I want to honor that and I want you to use this code. So once it comes time for you to do so, don't forget the code word insider. Type that in, it'll waive my fee. You can get on my calendar and come with your questions. Now I would ask that you listen to the audiobook. I go into more detail than what I just do right here on my whiteboard. So if you get a chance, listen to it. But if you want to just go ahead and jump onto my calendar, I have a quick little application that doesn't determine if you qualify or not. It just gives me the information I need to have an understanding so we can jump right in. I look forward to meeting with you. Thank you for your time today.